Today we're here with Archie Johnson from Mutual of Omaha. Tell us a little bit about yourself, Archie.
Well, my name is Archie Johnson. I'm with Mutual of Omaha Mortgage. I do the HECM product, the home equity conversion mortgage for seniors. Been in the upstate for over 30 years and absolutely love it here. Never see myself leaving.
Well, no, you said you were going to retire here, right?
I am.
There's lots of people coming here for retirement. They're getting tired of Florida. Awesome. Okay. Well, as Archie mentioned, he is sharing with us today the HECM product, which is the home equity conversion mortgage. Now, with the Mutual of Omaha, that is called the Lifestyle Home Loan. And so he's going to tell us a little bit more about that. And first, we're going to start with the eligibility requirements, correct?
To be eligible for a HECM or a home equity conversion mortgage, two things right out of the gate. One of the borrowers has to be 62 years old.
Yep.
And the property has to be used for a primary residence. It cannot be a second home or an investment property.
And what type of homes can that be?
Pretty much anything. Can be a FHA approved mobile home setup, mobile home land setup,
Yep.
Townhomes, condos. Condos can get a little tricky. We do have to have either a full community FHA approval from a condo or at least an approval on the individual unit.
So another question for you is, what makes your HECM product different from your traditional mortgage?
The biggest difference is a traditional mortgage, you borrow more and you make payments and pay it down. Pay it down monthly. With a home equity conversion mortgage, we loan you less, but you don't have to make payments.
No payments.
No payments. So your interest accrues and grows monthly.
Okay.
You're welcome to make payments if you would like, but you're not obligated to.
Okay. So if you wanted to buy it down quicker, you could make additional payments to.
You can. That's a great point. A lot of financial planners use it as a tool when we will refinance a mortgage and eliminate a payment. The homeowners may continue to make that payment to build in more access to their equity.
Okay.
It's a nice wealth building strategy.
Yes,
Right?
it really is.
Great wealth building.
All right. And I think there was one more thing about the HECM, and that really has to do with the home's value. So I think you mentioned something about.
Well, the how much you can borrow with a HECM. That's tied to a couple of different things. One, the age of the younger borrower.
Okay.
Again, one has to be 62, but the amount you can borrow is going to be based on the age of the younger borrower. And the reason for that is life expectancy.
Okay.
The older a borrower is, the more they can borrow because the life expectancy is less.
Alrighty.
Right? So that's a big factor. Mortgage rates are a big factor. The loan amounts were bigger back in 21 when rates were in the twos than they are now. And then obviously the value of the home factors into how much you can borrow.
Right. Awesome. Okay. So we had a couple of examples that we were looking at, right? Where essentially, the biggest thing that we're seeing a lot of is we've got somebody, they've got this great big nest egg locked in their home of equity. They want to go out and look at homes, but what they're finding is just not really what they want. So instead of being able to just buy what they want in that equity, you're saying essentially they can get something even a little bit more than that, right?
Exactly. Let's take an example of that retiring couple who's moving from Indiana to Greenville to be closer to the grandkids.
To the grandbabies,
right?
Yes.
They sell that home in Indiana and they get $400,000.
Okay.
Now I'm being very generous with the numbers.
Of course.
And I'm not factoring in age and I'm not factoring in closing costs.
Right.
But let's say they've got that $400,000 and they come here and they say, Alicia, Jada, what can I get for $400,000? If I don't want a payment, I can't afford a payment, and I'm not going to do it.
Yep.
Your problem is inventory.
Yep.
Right?
Definitely.
You show them what $400,000 can buy. What do they say?
No.
It's not even close to what I had.
Exactly.
Before.
Exactly.
Yeah.
So in theory, they could take that $400,000 nest egg. We could make them a $200,000 reverse mortgage loan. You now can show them a $600,000 home, and they still have no payment.
No payment. It's incredible.
So
Yeah, they would love that.
it really opens up the real estate agent's inventory offering.
Yes.
Great way to do that.
Absolutely. Fantastic. So obviously they move into this house, they have no payments, they are already seniors. So we're kind of looking at, I don't know, however many years, 15 or so, where then at that point they may need to go to assisted living, or maybe one of the spouses passes away. What happens when that happens?
That's a great question, Felicia. Let's take the first scenario. Last surviving spouse needs to go into assisted living. What happens is they can sell the home, and all of the equity remaining in the home is theirs.
Okay.
So they can put that in the bank.
Yeah.
Maybe they pass away. The last surviving spouse passes away. The heirs have 100% control over the equity of that home. The decision then falls to them. They can decide to sell the home. If that's the case, all the equity goes to them.
Okay.
Just like when we sell a home.
Right.
With a traditional mortgage.
Right.
Or maybe it's where they were raised. It's their home place.
Mm-hmm.
And they really want to keep the home.
Yeah.
They can go refinance that home into a traditional mortgage.
Mm-hmm.
Maybe they're 62 and want to refinance it
Into another house.
into another house.
Wow.
That's an option. Or if they have the cash, they can just pay the loan off.
Awesome. Excellent.
The other part of that I always want people to know is, what if we have another 2008
Yes.
when property values
time.
crash?
Yes.
A lot of people, their values dropped by 50%, and they were upside down in their mortgage. They owed more than the home was worth. The federal government has taken care of the senior through the Federal Housing Administration. This is an FHA loan. I haven't touched on it. But what would happen then is whatever debt over the value of the home, the FHA
We'll take
pays
care.
off
That's
and
excellent.
take care of it.
And that's not just a benefit for this person, but also their family.
Yeah.
Their
That's
family.
a huge concern for a
Oh.
lot of children who are taking care of their senior parents.
Well, and a lot of parents are afraid to leave this debt to
Right,
their
exactly.
heirs.
Yep.
You can never owe more than 95% of the value, regardless of what values do.
That brings a
In the
great
market.
sense of security
It
for
is
sure.
it is one of the greatest things in my lifetime the federal government has ever done for seniors.
Yep. Excellent. So I think there's just one more thing that we really want to cover about this HECM product, and that really has to do with outside of the purchase. You mentioned it can be used in a couple of different ways, right? So we talked about some wealth building strategies. So kind of go into that. I think you also mentioned you can use it for long-term disability for those who maybe don't have it in place yet.
Yes. A lot of financial advisors, a lot of insurance professionals, estate attorneys use it as a planning tool.
Okay.
Yes, you can use it to buy a home, but you can also use it in your financial planning plan to pay for long-term care.
Mm-hmm.
You can use it. There's a line of credit feature that grows year after year that you can use to offset down years in the marketplace in your portfolio. Because if the market's down, you don't want to keep making withdrawals from your portfolio.
Yeah,
of course.
So you use the HECM line of credit to do that while your portfolio recovers. Then you turn it off and turn the portfolio back on.
Wow.
It really extends the life of people's retirement portfolios.
Yeah. Excellent. Okay. Any other thing to note about this wonderful product or anything that you do?
There are a couple other ways that you can get money out of a HECM. You can get a lump sum of cash at closing. You can get a stream of payments.
Wow.
Based on your equity.
That'd be perfect.
Yeah.
Or any combination of the three if there's enough equity there.
Oh, wow.
It is an incredibly versatile product. No two loans are the same.
Yeah.
Right.
I tell people all the time, I never do the same loan twice.
Yep. I feel like that's real estate in general. Every deal is a little bit
Every
different.
deal.
For sure.
That's really it. And I'm in this business to help people.
Yep.
I love helping people, so let me know how I can help you.
Awesome. We appreciate it, Archie. Thank you so much.
Thank you again, y'all.